As the market reaches all new-time highs, driven by fast-growing AI stocks like Nvidia, Palantir, and several data center infrastructure companies, headlines are starting to warn about an AI bubble. Many are comparing today's rally to the dot-com era when the tech bubble burst, wiping out nearly 80% of Nasdaq's value, and it took 15 years to reclaim the 2000 peak. In this video, I will break down where we are in the AI revolution and whether we are heading toward trouble. I will also share key warning signs that investors should watch for when it's time to turn cautious. This channel is all about investing and personal finance to help you build wealth and retire early. To see whether we are in the AI bubble, let's first look back at how the dot-com boom unfolded and what ultimately caused it to burst. In the mid-1990s, as the internet took off, people quickly appreciated its convenience of connecting the world electronically. Emailing, chatting, finding information online, and eventually conducting business. But connecting the world wasn't cheap. Building the internet's infrastructure required heavy capital investment. Intercontinental undersea and inland cables had to be laid, while data centers and network hubs were built to process and route global traffic. As the internet usage surged, demand for infrastructure exploded, driving phenomenal growth for the companies building it. These included network equipment makers like Cisco and Lucent Technologies, as well as backbone providers such as AT&T, WorldCom, and Global Crossing. Many of these firms financed their expansion with massive debt. For example, Global Crossing, a major undersea cable builder, took on roughly $12 billion in debt against $22 billion in assets before going bankrupt when the dot-com collapsed. Once network bandwidths became widely available, the internet revolution entered its second phase, the boom of the web applications. Startups like E-Trade disrupted traditional financial institutions, while Amazon, Pets.com, and eToys.com began pulling customers away from brick-and-mortar stores. Investors were overly excited about the internet's explosive growth. Analysts predicted that online traffic would double every 100 days. As more web companies emerged, speculation fueled even greater demand for infrastructure, and the internet boom entered its final phase, the formation of the biggest tech bubble in history. The market soon became flooded with excessive network infrastructure and data centers. I remember visiting a friend in San Jose who worked for a fiber optic networking company called AboveNet and gave me a tour of their data center. I was so impressed after the tour that I bought the stock and made some short-term gains, but the company eventually went bankrupt in 2002, a casualty of the massive overbuild. After the fallout, industry experts estimated that 85% to 90% of all fiber laid in the US were unused, the so-called dark fiber. Back then, who would bet against once-in-a-lifetime opportunity, the third industrial revolution? After all, how could internet demand ever stop growing? Almost any company with the dot-com in its name could go public. Many were losing money and some barely had any revenue, yet they traded at valuations tens of times their sales. For example, online pet supply retailer Pets.com traded at 50 times sales. Even profitable companies like Cisco peaked around 200 times earnings and 30 times sales. In 1999, the year before the crash, IPOs surged past 480 deals, raising nearly $70 billion in proceeds, roughly $140 billion in today's dollars. That year, trading tech stocks was incredibly profitable for retail investors. I recall scanning for stocks jumping 20 to 30% on day one, buying before the close, and often pocketing another 20% gain on the next day. Starting with $10,000, I made my first $100,000 in early 2000 using margin. In those days, it was hard not to make money in stocks. Then came doomsday. The first warning sign appeared when Lucent Technologies reported a surprise earnings miss in January 2000, blaming weak telecom spending. Its stock plunged 28% that day. Soon after, its competitor Nortel reported large order cancellations that spring. What followed was a wave of bankruptcies. Pets.com shut down in November 2000, and eToys.com went under a year later. The bust continued through 2002. WorldCom, once a telecom giant, collapsed after its accounting fraud was exposed, and its stock fell 99%. The Nasdaq lost about 80% of its value before eventually recovering, and so did my stock portfolio. That's why I learned my first lesson in stock investing. Now let's fast forward to today's AI revolution. It began in late 2022 with OpenAI's ChatGPT, an innovation that shocked the world. Then in the quarter ended July 2023, GPU maker NVIDIA reported revenue doubling year over year, an early sign that AI computing demand was just getting started. Not long after, new AI competitors entered the race. Anthropic launched its cloud chatbot, and Google released Gemini. In 2024, AI data center construction accelerated as Microsoft's Azure, Amazon's AWS, and Google Cloud ramped up their investments. Together, these hyperscalers are pouring hundreds of billions of dollars into AI infrastructure. This all feels alarmingly similar to the early internet boom, when massive fiber optic networks were being built. From a valuation perspective, I do see some bubble-like pockets. The AI software company Palantir, for example, is valued at around 100 times sales and over 200 times forward earnings. Some quantum computing firms with little to no revenue are trading anywhere from 150 times to 600 times sales. Those numbers mirror the extremes of the dot-com bubble, if not worse. That said, NVIDIA, the most valuable company in the world, has a forward PE of 30, far below Cisco's peak multiple in 2000. So where exactly are we in the AI revolution? And is this rapid growth sustainable? Recent earnings calls from Microsoft and Meta suggest that AI demand, both internal and external, remains constrained by compute capacity. The revenue could have grown even faster if they had more AI infrastructure in place. OpenAI CEO Sam Altman echoed the same concern, noting that the shortage of compute is limiting the company's ability to launch new revenue-generating features. Clearly, we are still in the acceleration phase of this revolution. Another encouraging sign, the hyperscalers leading the build-out, Microsoft, Amazon, Google, are highly profitable and carry strong, big balance sheets. That's a stark contrast to Global Crossing and WorldCom during the dot-com era, which were deeply in debt and unprofitable. If we look at the US IPO market today, we've had around 160 deals this year, raising roughly $30 billion. And only about a dozen of those are AI-focused companies. That's a fraction of the numbers seen near the end of the dot-com boom. To move from the current infrastructure phase into the next stage of the AI revolution, we will likely to see more AI application companies emerging and going public as compute capacity improves. These applications can range from purely cloud-based software to embedded AI systems that control machines, such as autonomous vehicles and robotics. This mirrors the second phase of the internet revolution, the rise of the web applications, which ultimately led to the overbuilding and the final bursting of the bubble. Still, today's investment environment is very different from 30 years ago. Private equity and venture funding are far more accessible, which helps explain the smaller number of IPOs. Based on that, I believe we are in the early to middle stage of the second phase of the AI revolution. That's good news. It means investors can enjoy this market run-up for some time ahead. Finally, I also think the AI revolution could continue without a dramatic bust at all. Have you ever seen media headlines asking why we didn't experience a bubble-like expansion during the personal computer era of the early 90s or during the smartphone boom in recent decades? As long as AI applications can keep up with the rapid expansion of the infrastructure and continue to unlock real productivity gains and value for society, we could see a more sustainable path forward. Bubble or not, one thing is certain: growth never moves in a straight line, and the greatest companies always emerge from periods of technological revolution. Therefore, investors should stay invested for the long term while remaining prepared for potential downturns. Specifically, we need to watch for early warning signs of AI data center overcapacity. These would likely appear first among lower-tier suppliers in the AI value chain, chipmakers like NVIDIA and AMD, much like Lucent and Nortel were the first to struggle in 2000. A slowdown in hyperscaler capex guidance could also be an early indicator that AI demand is peaking. Another key risk comes from monetary policy. For instance, OpenAI has secured major investments from Microsoft, SoftBank, and NVIDIA. However, its plan to build 10 gigawatts of data center capacity by 2030 at around $50 billion per gigawatt still leaves a significant funding gap. That means OpenAI and its partner Oracle may need to take on significant debt to finance the Stargate project. If the Federal Reserve shifts back to tightening, higher borrowing costs will eat into margins and hurt returns, possibly trigger a major market meltdown. Luckily, at the most recent Fed meeting, policymakers resumed their rate cut cycle, and that easing could continue into next year. It's also possible that under the Trump administration, a more dovish Fed chair could replace Jerome Powell next May, helping support credit markets. Thanks for watching. Stay tuned for my future updates on the state of the AI revolution.